So let's go ahead and talk about our topic and our last story of the day. We are talking about OpenAI's alternative strategy, a pun that I absolutely fucking hate, and I can't believe that I wrote that earlier. I thought that I should keep it in there, but fuck it, whatever. You guys are going to see it tomorrow. In order to become world class at anything, you gotta be a little bit of a weirdo. What's up, peeps? Welcome back to the Daily Peel's daily podcast of the day, or in other words, your absolute favorite podcast on planet Earth. How do I know it's your favorite podcast? Well, probably because it's everybody on Earth's favorite podcast. We did run a poll. We found out the results 100%. Joe Rogan even hit me up. He was like, David, how are you doing this? And I was like, Joe, slow down. You're new to the game here. I'll give you some notes, watch some of the pods, and we'll be good to go there. So you'll probably see me on the Joe Rogan Experience relatively soon. But for now, let's go ahead and talk markets. Let's see what's going on, because we have a lot going on in the world here today. So it was an interesting day for markets. Very volatile session. We opened down about 1.5% for the S&P 500, but finished up over 1%. So all around, a big turnaround, and it was pretty much entirely due to the inflation report and the initial kind of headlining data causing jitters across markets. But then once analysts are a little bit slow, so once they had time to digest the information, then things got back to normal and markets started to react probably how they should to a report like this. We also saw NVIDIA roar back to life with a huge update, and we're also going to be breaking down some weird shit that's going on at OpenAI, and it's not just their employees that are the weirdos here, it's actually how the employees are getting paid. That's pretty weird too. Before we get into all that, we got a lot to cover first and foremost. So the WSO Alpha portfolio is up about 1.02% on the session, about 102 basis points. Drastically underperforming the NASDAQ. NASDAQ was up 2.17% on the day, and we were in the neighborhood in the S&P 500 up about 107 basis points. So relatively strong day. You know, the markets today were led by NVIDIA, and so we are underweight NVIDIA, especially compared to the NASDAQ 100, but certainly compared to the S&P 500. So that outperformance, despite the fact that we hold it, because we hold, it's less of a percentage of our portfolio than it would be for these indices, it's going to have less of an impact for us. And NVIDIA's energy was also a huge riser on the day. We'll talk about that in our banana bits in just a quick second. Speaking of banana bits, let's go ahead and get right into those. So first and foremost, investors are getting hyped up. Everybody seems to be getting collectively bearish, or has been getting collectively bearish over the past couple of weeks. But if you actually look at EPS estimates going forward that analysts are putting out, nearly all of them are getting revised higher for just about every period for the foreseeable future. At the exact same time, we're seeing declines in the projected odds for a recession from some of the top economists and fund managers around the world. Now, I respect an economist's opinion about the economy about as much as I respect my dogs, but still, nonetheless, it's the best we got. So, things are looking much better than the vibe on finance Twitter is, at the very least, or is in the media more generally. Meanwhile, this is a fun one. Norfolk Southern CEO was forced to step down yesterday amid a good old-fashioned sex scandal with their chief legal officer. The CFO of the company is stepping up. I believe this is the third largest railroad in the United States. It's got to be top 5 in North America, but I know Canada, that's the one thing Canada beats us on, is the size of their railroads, besides BNSF, Warren Buffett, putting out for the American team, as always. Solar stocks, here we go. Solar stocks had one hell of a day because based on Tuesday night's presidential debate, markets were kind of pricing. They basically said Harris smoked Trump in that debate. That's not me saying that. I don't have an opinion on it, at least not publicly. But markets are saying that Harris completely smoked Donald Trump. So what that means for solar stocks is that there's probably an increased probability that subsidies are going to be maintained or even more so extended. So obviously solar stocks got pretty hyped on that, on the increased demand therein. Enphase Energy up 5.7% for the session, leading the WSO Alpha portfolio next to NVIDIA. Meanwhile, Ireland, this was a great piece from Sherwood News. Love what the guys over at Sherwood are doing. It's great work, great reporting, some more interesting stories that the mainstream media thinks are too good to cover. Sherwood News is over there. Ireland has been Ireland is getting its bag more so than anybody else in the EU. The EU, we all know, it's basically a museum at this point, but Ireland is effectively a money vacuum. It's a bank vault. It's the opposite of printing money. They're collecting money. So Ireland is kind of a tax haven in Europe, at least for corporate taxes. So, companies like Apple just got forced to pay them $14.4 billion in VAT taxes, to where all the big tech companies and all the multinationals that operate in the EU register, so they just could rake that all in. Read about how it is right there. Ireland, population still below that of when the potato famine was going on back in the 1840s, but still, their bank accounts are certainly a lot higher. Okay, and meanwhile, ABC moderators David Muir and Lindsay Davis, they came heavily under fire. Speaking of the debate, I think those two probably won the debate because it didn't seem like really anybody did. But a lot of people, Wall Street Journal reporters especially, are saying that it was an unfair debate, alleged that, they were fact-checking one candidate much more than the other, is basically what we're seeing. So, we don't get to the politics here, but it's something that's been going on in the news, so I figured I should tell you guys about it. Considering that this is the most influential, popular, important, your favorite podcast in the entire world. Okay, let's go ahead and move into our macro monkey story of the day. We're talking about of mice and elephants, a little bit of artistic masturbation on my end for you guys here today. Of Mice and Elephants, very much like Of Mice and Men. Great book right there. I would have to say that I'm probably Lenny in this situation, but still, let's go ahead and get right into it. There's an old urban legend that elephants are afraid of mice. I don't think that it's actually true, but I'm certainly going to pretend it's true for the day because that makes it way funnier and that makes this analogy make sense here. Because effectively, what happened, the reason that markets threw up in the early session here on Wednesday was because of a slight uptick in inflation on the core CPI side of things, just on the monthly basis. So let's go ahead and talk about what happened. It was a very slight change, but markets completely freaked out. Elephant-sized stampede, getting out of the equities market in response to these numbers. So let's go over some of the headline numbers first. On a monthly basis, consumer inflation increased 0.2% in August, according to the CPI report. That is right in line with July. That's back-to-back months of 0.2%, slightly above the rate that would be needed to achieve the 2% annual inflation target of 0.165%. Now, with the CPI report, they only round to the first decimal for these headline numbers, so we don't know. It could have come in at that 0.165% or relatively close to that range. I'm sure you could go ahead. I probably should have just calculated these numbers before I started talking about this shit, but nonetheless, it's right in that range, so that makes us feel better about inflation going forward. As usual, we know who the main characters are here. Shelter, once again, hogging all the spotlight away from everybody else. Shelter costs rose 0.5% for the month, and were described as quote-unquote the main factor, aka the main character in the monthly increase for that headline number, and certainly on the core side as well. Energy was working hard for the American people, down 0.8% at the headline, whereas 1.9% declines were observed in fuel oil as well as gas services. So once again, energy is doing the heavy lifting in terms of decreasing costs. This is still largely ramifications from the huge uptick in energy prices that we saw post-Russia's invasion of Ukraine that kind of slowly trickled down all throughout 2023 and are continuing to trickle down right now. Food prices, for the meantime, rose 0.3% away from home, and for the fucking misery of making food for yourself at home that tastes like absolute dog shit, or maybe that's just me, that only rose about 0.1%. So really, what's going on here? Well, within core inflation, obviously core inflation excludes food and energy prices. That's the difference between the core reading and the headline reading. So when you're excluding food and energy, you're going to be much more heavily weighted to everything else because those are relatively big factors in the headlining number. So shelter inflation plays a much bigger role than it usually does, and shelter already takes up a huge percentage of the CPI report. It's even higher on the core side. So that 0.5 increase that we saw on the monthly basis contributed even more so and pushed the core inflation rate up to 0.3% in August. This is exactly why markets freaked out, because the July reading came in at 0.2%. The initial assumption was, oh shit, run for the fucking hills. Inflation is coming back. We gotta take cover. But quickly, once they kind of took a step back, digested the numbers a little bit more, like I said, analysts are a little bit slow with this stuff. We gotta give them cut them some slack there. Let them take some time to digest this information. Then they realized really isn't a big problem at all. Headline inflation on the annual side grew 2.5% in August. That is the lowest that we've seen in 42 months, or specifically since about February of 2021. So very long time. Core inflation on the annual side grew at 3.2%, right in line with July and June's figures. So core inflation staying relatively sticky at the 3.2% level, primarily due to shelter costs. Headline CPI is still continuing to trend lower at a healthy 2.5% right now. So overall, relatively decent inflation report. The big factor here, once again, this is like the 8th month in a row that shelter is doing all of the heavy lifting, but it's really not a bad thing. Kind of a best case scenario, actually, to see that shelter is what's pushing the indexes higher. The Federal Reserve is aware that, shelter has its issues. We've talked about owner's equivalent rent a bunch of times. The way that they calculate owner's equivalent rent, which is 33%, typically in the range of 33% of the entirety of the CPI report, the headlining CPI report. The way that they calculate this is they essentially call people and say, hey, how much would you rent your house for? Now, Shelter costs generally make up about 42% of the CPI report, somewhere in that range. So that remaining 9% is all lodging away from home, as well as what they claim is direct rental prices. But all of these prices are also done on a major lag. Now, the Minneapolis Fed has estimated that that lag could be up to 12 months in its worst-case scenarios. So what we're seeing on the shelter side largely reflects what we actually saw in 2023 and doesn't really play a factor right now. If you look at the Redfin rental price index, we're actually seeing declines in a lot of cities around the United States. So this is causing a lot of concern that inflation is already well below that 2% figure in actuality, and we just don't have the tools to measure it very well because the CPI is what a fucking fifth grader would come up with to measure inflation across the country. We've been doing it since the 1960s, and I think technology's gotten a little bit better since then. So there's almost certainly better ways that we can go about this. But nonetheless, the big movement on the day was that basically what happened and the reason that market sold off was because that initial reaction to the uptick in core inflation caused markets to drastically lower the odds for a 50 basis point rate cut in September. Now, the odds are still locked in for a 25 basis point cut, but on Tuesday, the odds of a 50 basis point cut sat at roughly 1/3. They were at 34%. When I looked at this earlier today, they were now at 13%. So because the probabilities of a 50 basis point and a larger cut are lower, that caused equity prices to sell off. Now, once everybody kind of took a step back and realized, shit's actually not that bad, markets started to turn back up, but maybe if we keep our fingers crossed and, set up our prayers and everything, we can get an absolute economic collapse over the next week or so and actually get that 50 basis point rate cut. Maybe that will actually turn markets back around. All right, moving into some of our big stock movers of the day here, we have Petco Health and Wellness. The stock is up 32.90% on the session for absolutely no fucking reason. I love my dog as much as the next guy, but holy shit, these results were mediocre at best. The company came out and reported its second quarterly numbers. Basically, they came out and said that revenue fell about 0.5% on an annual basis, but losses came in a little bit narrower than expected. The company only lost about 2 cents per share against estimates for 3 cents per share losses. And we did see some segment of Petco's revenue were holding up a little bit, or much better. Grooming and veterinary services, for one, carried the team with 3.1% revenue growth, but they saw declines in some of their other units. So this is kind of, I don't know why the stock is up nearly 33%, probably because it's been selling off for, a good time before this. It's clear that markets are starting to realize that pet spending is quickly becoming more of a consumer staple rather than what has historically been considered a consumer discretionary. Fido used to sleep outside. Now he's in the king bed with mom and dad. So that's probably the reason that the stock's going up so much, especially as we head into a period of both market and macro uncertainty. People want to go with staples, and if they're just figuring out that pet spending is a staple, maybe that could push prices higher. But either way, it certainly seems like an outsized reaction to us here at the Daily Peel. NVIDIA shares up 8.03% on the session. The stock has been falling apart since its earnings, but nonetheless, Jensen Huang came out here. He proved to everybody today why he's out there, signing people's boobs and shit at their quarterly reports. He really did that, and if you don't believe me, go and check out the piece because it's linked within there. He's literally a rock star. He's at that status, and he kind of proved exactly why he is today. So the big concern since NVIDIA reported its earnings is that AI demand isn't going to be there on the hardware side of it going forward for much longer, and NVIDIA is going to have to make some kind of a pivot in order to be able to keep up with the kind of growth that it's set for itself. But Jensen basically came out here at a Goldman Sachs event. He was asked basically that exact same question. Long story short, he said, certainly there's going to continue to be that demand for GPUs because not only do we use, artificial intelligence for these, like it's not just model training and inference that's going into it. So these artificial intelligence systems are doing more coding than software engineers at this point, and it's only going to maximize, it's only going to increase going forward. We're going to have virtual software engineers that are doing most of the coding. In order to do so, you need GPUs, and, as we kind of continuously build more and more software gets demanded. It's a network effects problem right there. And so Jensen basically quelled all of those concerns. Once again, the stock is up 8.03% on the day. Moving on down into our stinky, rotten movers of the day, we have GameStop, my absolute favorite stock to make fun of. I was kind of behind this thing back in college, but holy shit, it just makes me, it's an abomination. It makes my fucking skin crawl at this point because people are losing money in this thing. And, even though Keith Gill might be making money, all he's doing is coming out here and creating exit liquidity for himself. So really, scumbag activities, if you ask me. Speaking of scumbag activities, the only gaming that is going on even remotely connected to GameStop right now is gaming of financial results. Now, I'm not alleging accounting fraud or anything because nobody at GameStop could even fucking figure out how to do that, I'm sure. But Basically, the company came out with an earnings report today, and their bottom line EPS actually did beat expectations. So they registered a surprise profit of 3 cents per share against an expected loss of about 9 cents per share, but it was entirely due to their interest income. So operating income was actually negative already because the biggest reason for operating income's decline was that SG&A costs declined 16% compared to the second quarter of 2023, whereas sales declined 31% compared to the second quarter of 2023. So SG&A costs are drastically increasing as a percentage of revenue. That's taking a hit into the operating income. Operating income was negative, but once you added back interest earned on its cash balance, then the company was actually profitable for the quarter. Now, the funniest thing to me is that CEO Ryan Cohen has been given permission to trade the company's cash balance. Clearly, it seems like the interest income is doing much more of the heavy lifting than his trading, which just makes this even fucking funnier. But nonetheless, maybe Roaring Kitty will put out some fucking meme or something that's going to make us all billionaires or something like that. Like, let's get a little bit realistic here and stop giving this guy free exit liquidity. Okay. Trump Media and Technology Group. Now, since I pissed off all the fucking meme stock traders, might as well go ahead and piss off everybody else. Trump Media and Technology Group down 10.47% on the session here today. Do I really need to tell you why? First of all, this is barely a company at all. Second of all, the best way to describe its trading action today, 4 little words. That's all I need to do it. LMAO. It was absolutely hysterical. Once again, stopped down 10.47% on the day, and honestly, I have absolutely no idea why. Yes, you could say that it's because of a perceived weak performance in the debate on Tuesday night. That's, up for debate. A lot of people are saying that he actually did particularly well in that debate. So, very open to interpretation on what you think about his performance there. But how it relates to the company's value doesn't make any sense to me at all. Now, first and foremost, I thought the debate was pretty evenly matched, but even if Trump got absolutely smoked, there was no chance that if he said the N-word on stage or something, and there was no chance that he was ever becoming president ever again. Isn't that a better thing for this company? Trump is the company. He's the integral, crucial part of it. He also owns 80% of the company itself. Presumably, if he gets back in the White House, he's going to have to divest his shares and step away from the company for risk of conflict of interest. So wouldn't you want the guy that the company is named after to still be at the company? Wouldn't that, at least in theory, help the company? I don't know why you would want this guy to step away, but that's really, like I said, this stock is barely a business at all. So it's really trading more so on vibes and basically just, how good Donnie T is looking in the fucking news that week. So, I mean, the fact that Biden put on a Trump hat today and the stock is still down 10.5%, maybe it would have down 15-20% if Biden didn't put on that Trump hat, but still, that was actually a pretty funny image as well. And if you haven't seen it yet, go ahead and check out yesterday's piece because, once again, there's a link in there. We got all the good links. You don't become the world's most popular and influential newsletter and podcast without having the right links. Okay, let's go ahead and talk about our thought and our last story of the day. We are talking about OpenAI's alternative strategy, a pun that I absolutely fucking hate, and I can't believe that I wrote that earlier. I thought that I should keep it in there, but fuck it, whatever. You guys are going to see it tomorrow. In order to become world-class at anything, you got to be a little bit of a weirdo. You look at Olympic athletes, all of them are kind of freak shows. Now, in order to be interested in technology enough where you can, get to the level you need to be to understand artificial intelligence, machine learning, all that other nonsense that goes on there, you got to be a little bit weird as well. So being world-class in artificial intelligence and machine learning, you get the ultimate combination of weirdos right there. That's exactly what we're seeing at OpenAI. I wouldn't be surprised if there's similar, fuck dens going on in there like there was for FTX or something like that. But either way, the reports on that haven't come out just yet. And now I have that fucking image in my head and I want to go throw up before I continue this. But nonetheless, let's talk about what's going on at OpenAI right now. So the company TechCrunch reported earlier this week, actually they reported it earlier today, that OpenAI is looking for a new funding round. They're looking to raise about $5 to $6 billion from a bunch of different investors that are looking to throw money in there, shaking ass for Sam Altman so that they can get a piece of this company. And effectively, we're looking at banks. We're looking at Thrive Capital. There's a big venture capital fund that's looking at making an investment here. And, of course, Big Daddy Microsoft is still in the game as well. Not that crazy that they're raising money, but it is fucking insane that they're raising money at a $150 billion valuation. That makes them not only one of the most valuable private companies in the world, but one of the most valuable startups in the world, but one of the most valuable private companies, full stop, period, in the entire world. $150 billion if they were actually able to do so. But the thing is, in order to raise these funds, they're not selling debt, they're not selling equity. It's actually super weird what they're doing in order to do so. So the funds that they're going to be looking at selling are what are called they're called PPUs, which I'm totally blanking what the acronym stands for right now. So let me go ahead and just double check on exactly what that was. Profit participation units. I didn't even find it in the piece, just so you guys know, but that's exactly what they're called. Profit participation units is essentially what OpenAI is selling. This is the equivalent of stock-based compensation that they pay to employees. So let's take a step back. Most of the time, if you get hired by a company, especially a tech company, let's say it's a Snapchat, for example, because they pay employees a ton of money in SBC. If you work for Snapchat, they're going to pay you a base salary, call it $100,000 or so. Now, they're also going to say, okay, you can get, X amount in equity ownership via, restricted stock units, performance stock units, profit interest units, all this different kind of shit. But PPUs are very different from that. They're not giving you equity ownership in the company like those other vehicles are. So equity ownership, what that brings in addition to exposure to the company's value is things like voting rights, things like a claim on assets in a liquidation event. Now, you might be the last in line, but there is intrinsic value with equities because, in theory, you can at least get a piece of the fucking factory before they sell it, or in this case, of the data center before they sell it. Now, with, I keep blanking on this. What is it? Profit participation units. With profit participation units, they're essentially just IOUs for future profits that could come. Not necessarily will, but could come. Now, it sounds very similar to stock ownership because what everybody says when you're buying a stock is that you're buying into the company's future cash flows or its future earnings, whatever way you want to phrase it. Now, what the hell is it? Profit participation units. Holy shit, I can't believe I keep forgetting that. Profit participation units basically say, okay, David, here you go. You're going to get a claim on X amount of profits. After we hit a certain threshold, you're going to get a claim on X amount of profits above that line. So they say, hey, listen, we're going to wait until we have $5 billion, say, in total profits. Then once we get up there, you can start to collect X amount, whenever is agreed upon. Typically, at OpenAI, at least, this is going to vest over a 4-year period. So you're going to get 25% of that value each year, and it's going to be coming directly from those profits. OpenAI has absolutely no profits. It's estimated that they'll lose about $5 billion this year because it costs so much goddamn money to keep ChatGPT running so that it can come up with games for you to play with your kids on the weekend or help you fucking cheat your way through exams and essays, which I totally would have done if this was a thing in college, but I probably would have got caught for fucking plagiarism. So it's probably good that it wasn't actually, but still, it's a little bit strange because people are fucking throbbing with horniness over how bad they want exposure to these performance why do I keep saying that? These profit participation units. People are freaking out over this stuff, even though there's absolutely no intrinsic value. Just shows how bullish everybody is on OpenAI and on artificial intelligence going forward. Okay, that about does it for us here today. Before I forget any more acronyms, let me go ahead and read you guys the quote of the day that we have from Mr. Howard Marks, the founder of Oak Tree Capital Management, I believe, came out here and said, being right is not the key to investment success. You have to figure out what's wrong. So it's more important to be focused on what's wrong than necessarily is what's right, so you can improve from there, go forward, and stop making those same mistakes over and over again. All right, that about does it for us here today. Hope everybody's having a great week out there so far. Send us an email if you have anything that you want to talk about or want us to shout out anything. We're looking to become a little bit more interactive with you guys. So shoot me a message, David@WallStreetOasis.com. And I guess I'll be looking forward to it if anybody actually reaches out. But nonetheless, thank you guys all for joining us here once again. Happy investing, happy trading, and bye now.